Trade routes determine more than the flow of goods. They shape the distribution of wealth, the location of strategic leverage, and the structure of political influence. Ports become centers of power. States controlling key passages extract rents and dictate terms. Merchants financing governments gain institutional access. Networks expand reach without territorial conquest. This structural pattern, trade networks reshaping political authority, operates across historical periods. The Silk Road shifted influence toward states controlling Central Asian passages. Venetian shipping networks translated maritime dominance into Mediterranean political weight. Dutch global trade created leverage far exceeding the Republic's territorial size. British control of sea lanes financed administrative capacity and military reach. The mechanism is logistical and financial. Trade generates revenue that funds state institutions. Networks create dependencies that translate into influence. Infrastructure, ports, warehouses, credit systems, naval protection becomes the scaffolding of power. Authority follows not just where armies march, but where goods flow. How have trade networks reshaped political authority across eras? And what institutional mechanisms translated commercial dominance into structural influence? Ancient trade as background infrastructure. Long-distance trade existed for millennia. Silk Road connecting China to Mediterranean, Indian Ocean maritime routes, trans-Saharan caravans. Goods moved, silk, spices, metals, grain, luxury items. Trade was understood primarily as economic activity, merchants facilitating exchange, cities serving as market hubs. Political power was framed in terms of territorial control, military strength, dynastic succession. Merchant republics and commercial leverage. By medieval and early modern periods, certain states derived power directly from trade. Venice, Genoa, later Dutch Republic. These entities lacked large armies or extensive territory, yet wielded disproportionate influence. Their strength came from controlling commercial flows, not land. Why trade networks mattered structurally. Trade generated revenue through taxation, tariffs, port fees, funding state capacity. Control of key trade routes created strategic leverage. States could permit or deny passage, set terms. Credit systems developed around trade. Merchants financed governments in exchange for monopolies, charters, policy influence. Infrastructure investment, ports, warehouses, canals, naval protection became state priorities. Incentives driving network formation. Rulers sought revenue beyond land taxation, which was limited and politically sensitive. Merchants sought legal protection, property rights enforcement, access to distant markets. Mutual dependence emerged. States provided security and legal frameworks. Merchants provided capital and commercial expertise. Institutional arrangements evolved. Chartered trading companies, guilds, maritime insurance, bills of exchange. The shift in political calculation. States began prioritizing control of trade routes alongside territorial expansion. Naval power was directed toward protecting commercial shipping, not just conquest. Diplomacy increasingly involved negotiating trade agreements, access to ports, commercial privileges. Cities with strategic port locations accumulated wealth and political weight disproportionate to their size. Structural transition line. Power began to follow the routes, along coastlines, through strategic straits, and into hubs where goods accumulated and credit flowed. The Silk Road and dynastic influence, 2nd century BC, 14th century AD. The Silk Road was not a single route, but a network of overland paths connecting China to the Mediterranean. Control over key segments translated into political leverage. Chinese dynastic power. Han Dynasty 206 BC, 220 AD, expanded westward partly to secure trade routes. Silk, a monopoly product, generated revenue and diplomatic leverage. States along the route, Persian empires, Central Asian khanates, extracted tolls and customs duties. Trade revenues funded administrative capacity, military campaigns, infrastructure. Central Asian intermediaries. Cities like Samarkand, Bukhara, and Kashgar became wealthy hubs. Local rulers taxed caravans, provided security, and mediated disputes. These cities wielded influence disproportionate to their military strength. Merchants needed stable passage, and rulers who ensured it gained commercial and diplomatic weight. Structural insight. Control of chokepoints, mountain passes, desert oases, gave small states leverage over larger empires. Trade dependency created political relationships. Empires negotiated rather than conquered. Networks expanded influence beyond borders. Venetian Mediterranean dominance, 9th, 15th centuries. Venice lacked agricultural land and a large population. Its power came from shipping networks. Maritime infrastructure. Venice controlled Adriatic shipping and Eastern Mediterranean trade. State-owned shipyards arsenal produced standardized vessels at scale. Convoys protected by Venetian galleys ensured safe passage. Port infrastructure in key locations, Crete, Cyprus, Corfu, supported logistics. Commercial political integration. Venetian merchants were often also state officials. Commercial and political interests aligned. Trade revenues funded naval power protected trade, a self-reinforcing cycle. Venice negotiated treaties with Byzantine Empire, Ottoman Empire, and European states based on commercial leverage. Credit and taxation. Venice developed sophisticated public debt systems, prestiti, to finance trade and defense. Government bonds were held by merchant families, tying commercial success to state stability. Customs duties from trade financed state administration, naval expansion, and diplomatic missions. Structural outcome. Venice wielded Mediterranean influence without territorial empire. Other states, including larger kingdoms, negotiated with Venice because it controlled commercial flows. Commerce created leverage without conquest. Dutch maritime trade networks, 17th century. The Dutch Republic was small, with limited agricultural resources. Its global influence came from trade networks. Global reach. Dutch East India Company, VOC, controlled spice trade in Southeast Asia. Dutch West India Company operated in Atlantic trade. Amsterdam became Europe's financial hub, credit, insurance, commodity exchanges. Dutch shipping dominated Baltic grain trade, herring fisheries, Asian luxury goods. Institutional innovation. Joint stock companies allowed capital pooling, financing large-scale voyages. Bills of exchange facilitated credit across distances. Maritime insurance reduced risk for merchants and investors. Legal frameworks protected contracts and property rights. Naval protection as commercial strategy. Dutch Navy protected trade routes, not primarily for conquest. Convoys escorted merchant vessels. Naval bases secured strategic ports, Cape of Good Hope, Batavia. Naval power was calibrated to trade protection, efficient, not imperial. Political leverage. Dutch financial markets financed other European states, England, France, Austria, giving diplomatic influence. Control of key commodities, spices, sugar, textiles, created dependencies. Small territorial size did not constrain global influence because leverage came from networks, not land. Power began to follow the routes. Britain's global influence was built on trade networks as much as territorial empires. Naval dominance and trade protection. Royal Navy secured sea lanes, protecting merchant shipping globally. Strategic bases, Gibraltar, Malta, Singapore, Cape Colony controlled chokepoints. Naval superiority ensured British merchants could trade with minimal interference. Trade and imperial administration. Trade revenues financed colonial administration. India governed partly through East India Company profits. Customs duties, port fees, and monopoly rents funded state capacity. Global trade networks required and funded extensive bureaucratic infrastructure. Credit and financial systems. London became global financial center, credit markets, insurance, commodity futures. British banks financed trade worldwide, creating dependencies. Sterling-denominated trade made London central to global commerce. Institutional reinforcement. Legal protections for property rights and contracts attracted international merchants. Stable currency and gold standard facilitated long-distance exchange. Infrastructure investment, canals, railroads, telegraphs further embedded British commercial dominance. Structural consequence. British political influence extended far beyond formal colonies. States dependent on British trade and finance deferred to British diplomatic preferences. Networks expanded influence beyond borders. Common structural pattern across cases. Each example demonstrates trade networks generated revenue beyond land taxation. Control of infrastructure, ports, routes, financial systems created strategic leverage. Naval or security forces protected commerce, not just territory. Credit systems linked merchant capital to state capacity. Institutional arrangements, charters, treaties, legal frameworks sustained networks. Commerce created leverage without conquest, ports, credit, and logistics reshaped authority as much as armies did. Pattern 1. Control of chokepoints translates into leverage. Narrow straits, mountain passes, port cities wherever trade must pass become strategic assets. States controlling these locations extract tolls, dictate terms, and influence regional politics. Examples: Venetian Adriatic control, Dutch Cape of Good Hope, British Gibraltar and Suez. Leverage is structural. Denying passage disrupts commerce, giving small states bargaining power over larger entities. Pattern 2. Merchant capital finances state capacity. Trade revenues provide alternative funding to land taxation. Governments that secure trade routes gain revenue to fund administration, military, infrastructure. Merchant loans to governments create mutual dependency, states protect commerce, merchants gain policy access. Examples: Venetian public debt held by merchant families, Dutch financing European states, British East India Company funding colonial administration. Pattern 3. Infrastructure investment creates long-term influence. Ports, warehouses, canals, telegraphs, physical infrastructure embeds commercial dominance. States that build and maintain this infrastructure become hubs, attracting further trade. Network effects reinforce dominance. More trade, right arrow, more investment, right arrow, more trade. Examples: Venetian Arsenal shipyards, Amsterdam's commodity exchanges, British global telegraph network. Pattern 4. Credit systems extend reach beyond territory. Bills of exchange, maritime insurance, joint stock companies, financial innovations enable long-distance trade. States with sophisticated credit systems attract merchants and capital. Financial dependency creates political leverage. States reliant on foreign credit must accommodate creditor interests. Examples: Italian banking networks financing European monarchs, Dutch credit markets, London as global financial center. Pattern 5. Naval power protects commerce, not just territory. Navies secure sea lanes, escort merchant convoys, maintain bases at strategic locations. This differs from purely territorial conquest. Naval forces calibrated to trade protection. Trade-protecting navies create influence without occupation. Examples: Venetian galley escorts, Dutch convoy system, British Royal Navy patrolling global routes. Pattern 6. Trade dependencies create political relationships. States dependent on specific goods, spices, grain, textiles, negotiate to ensure access. Suppliers gain diplomatic leverage, can threaten disruption. Dependencies reduce likelihood of conflict, mutual interest in stable trade. Examples: European dependence on Asian spices giving Dutch leverage, British grain exports influencing European diplomacy. Pattern 7. Institutional stability attracts commerce. Legal protections for property, contract enforcement, stable currency, institutional quality matters. Merchants prefer trading through stable jurisdictions. States that provide institutional stability become hubs, accumulating wealth and influence. Examples: Venetian legal frameworks, Dutch commercial law, British common law protections. These patterns describe how trade networks translate economic activity into political leverage. Through infrastructure control, financial systems, strategic dependencies, and institutional quality. Power follows flows. 19th century industrial shipping networks. Steam-powered shipping reduced voyage times, expanding global trade volumes. Coaling stations became strategic assets. British control of global coaling networks sustained naval. Suez Canal, 1869, restructured global trade routes, shifting influence toward states controlling access. Railroads connected interior regions to ports, integrating continental economies into maritime networks. Early 20th century trade and diplomatic leverage. International trade agreements, tariffs, most favored nation clauses became diplomatic tools. States used trade access as bargaining leverage in negotiations. Financial markets, London, New York, influenced sovereign credit ratings affecting state capacity. Trade dependencies shaped alliance patterns, though not deterministically. Post-colonial trade infrastructure. Former colonies inherited port infrastructure, rail networks, and trade relationships from imperial periods. These inherited networks continued to shape economic and diplomatic patterns. Port cities retained disproportionate influence in newly independent states. Credit systems linking former colonies to European financial centers persisted, creating structural dependencies. Observational note on container shipping. Mid-20th century containerization revolutionized logistics, reducing costs, increasing volumes. Hub ports Singapore, Rotterdam, Hong Kong became critical nodes. States controlling these hubs gained strategic leverage in global supply chains. Network effects concentrated influence. Larger ports attracted more shipping, reinforcing dominance. Across periods, the pattern repeats. Infrastructure, credit, and network centrality translate into influence. The mechanisms evolve, sail to steam, telegraphs to fiber optics, but the underlying dynamic persists. Trade networks reshape power not through conquest, but through logistics, credit, and strategic dependencies. States controlling key passages extract rents and influence flows. Merchants financing governments gain institutional access. Infrastructure investments embed long-term advantages. Naval forces protect commerce, extending reach without occupation. Financial systems create dependencies that translate into diplomatic leverage. This pattern appears across eras. The Silk Road shifted influence toward Central Asian intermediaries. Venice dominated Mediterranean politics through shipping networks. The Dutch Republic wielded global leverage despite small territorial size. British trade infrastructure funded the empire and shaped international relations. Each case demonstrates how commercial flows translate into political authority. The mechanism is structural. Trade generates revenue, funding state capacity. Networks create dependencies, giving hub states bargaining power. Infrastructure, ports, credit systems, legal frameworks becomes the scaffolding of influence. Authority follows not just where armies march, but where goods accumulate, credit flows, and networks converge. Understanding power requires examining both military capacity and commercial infrastructure. Armies may draw borders, but trade networks quietly shape influence through routes, hubs, and flows that persist across generations, reshaping the geography of authority.